Welcome to the Financial Freedom Mastermind Group podcast. Here we're all about breaking free from the 40 to 50-year work grind and accelerating our journey towards financial freedom. Join us every Wednesday at 7 p.m. Eastern as we explore different types of investments that can fast-track your path to financial independence. We serve as a hub for connecting with fellow members during our sessions so you can share successes, ask questions, and keep the momentum going.
Good evening, everyone. This is Niyi Adewole, host of the Ekabo Home Financial Freedom Mastermind Group. And tonight I am joined by Earl Yaokasin, who is one of the financial architects that's helping individuals build financial freedom through investing their money smartly. And Earl, we're so happy to have you with our group today.
Well, thank you for having me, Nee. I appreciate it.
Absolutely. And Earl, one of the things that really intrigued me about your background, which resembles a lot of the individuals that we have a lot of people that come from all over in different walks of life that are now working toward financial freedom. But I know that you were born in the Philippines. You
Yes.
started from scratch in the US, working long hours and commuting a long distance to get your CFA. Can you take us back to some of those early days and what kept you going?
Well, thank you for asking. Yes, I was definitely born and raised in the Philippines. Ever since I was a kid, I was always trying to make some extra money. So when I was in first grade, I would go around the school, I would look for soda bottles, turn them in for the recycling credit. And once I've had 10 of them, I can buy myself a delicious Filipino barbecue pork skewer. Have you ever had one of those?
I have it, but it sounds good.
Okay. Yeah, it's super good. And then in second grade, I started selling snappable bracelets, all colors, all kinds of designs. And then as I grew older, I sold concert tickets, cell phones, fireworks, you name it, CDs. I sold it. I went door to door just selling stuff, trying to make some extra bucks. But then one day I turned on the CNBC channel and then I saw things going up and down. And I've always been great at games and I've always been good at math as well. I won a silver medal in seventh grade in a national math competition. And I said, I can do this. And in the Philippines, the stock market is more about who you know rather than what you know. It's all about connections. There's a lot of insider trading. So brains don't mean anything in the stock market in the Philippines. So I went to the US. I went to the US with very little money. I had to make ends meet. And in order to do that, I needed to work two jobs at the same time. So my first job was, are you familiar with Los Angeles at all?
Yeah, I've been to LA a couple times. I have some friends out that way.
Okay, so there is a place in city in east of LA called Rancho Cucamonga. It's about maybe an hour away, something like that. So I lived in Rancho Cucamonga, and then my first job was in Pomona at 7 a.m. I ended my first job at 4 p.m. And then I traveled to Pasadena at 5 p.m. to work my second job, and then I'd finish at 9 p.m. and then do the same thing over and over again for more than a year just to make ends meet. And so it was definitely a very difficult time. I'm not proud of it. Sometimes I would fall asleep driving back home and I would have to turn the radio on like super loud and sing myself so that I won't fall asleep. So I did that. And then after a while, thankfully, I was able to get a job at American Express Financial Advisors as a financial advisor. And to my surprise, coming from the Philippines, I didn't know anything about how things worked here. So to my surprise, that the average financial advisor here in the country is just actually just like a salesperson. They're not trained. All the company cares about is you making the sale, you making the commission, and that's not what I was looking for. So then I transferred to Bank of America Investments, which is now Merrill Lynch. I supported the top two financial advisors in the region, and they were more focused on bonds. So after a while, after I've earned their trust, they were able to delegate all the stock picking to me. And my stock picking did significantly better than the in-house department. And so I started for the CFA, which you mentioned, which stands for the Chartered Financial Analyst designation. It's the most prestigious designation in the industry. And so this is from a former colleague of mine. she said that she has the CFA designation, the CPA designation, and the CFP designation. So according to her, she said that the CFA designation is 10 times harder to get than the CFP, 4 times harder to get than the CPA designation. So it was a long road. To get the CFA designation, it took 3 grueling years. And I eventually worked for the Capital Group, which owns the American funds. I don't know if have you heard of the American funds?
I have not. No.
Okay, so they are one of the largest mutual fund companies in the country. And Capital Group, it was at the time when I started with them in 2007, they were the third or fourth largest investment company behind Vanguard Fidelity. So they were really large. And so, yeah, I stayed with them for 7 years. But when my personal investment performance did better than almost everybody that I worked with, I started my own firm in 2014.
Nice. And that's pretty incredible. So you've been in business for over a decade now, and they say most businesses fail within the first 5 years, but you clearly are not most businesses. And so I would say a couple questions that come to mind. One, when you think about that season of sacrifice, right? The year where you were literally working 24/7 or sleeping, right? And driving long, long distances. And you think about some of the lessons that you learned along that time, even when you were going and pursuing the CFA and it took you 3 years to get it. Do some of those still influence how you invest and advise today? And if yes, which ones do?
Yeah, so definitely it's the hard work is needed in order to become a good investor. So one of the things that I observe with most people when they plan a vacation, they research hotels, they research the flight, they research what they need to do. But when they make an investment decision, oh, I heard it from my coworker that this stock is going to go up. And then they'll just buy it without any research, without any thinking. And definitely, you need to spend a lot more time researching your investments than planning your vacation. So that's one of the habits that I think people need to take away from this in podcast. And that's one of the things that I continue to do to this day, which is I study the financial statements cover to cover. I listen for every quarterly earnings report. I'm on the call listening to management talk about what happened during the quarter. And I talk to a lot of customers, employees, try to get a sense of different varying opinions to make sure that I've considered all different perspectives before making the investments. And as I continue to own the investments, whether I need to change my mind on anything. So those are two key things that I would say that your audience can take away from.
Absolutely. And I think you're spot on. It's a funny story, but it's true. Like people will plan out a vacation for a year in advance, but when it comes to, hey, what do you want your future to look like from an investing standpoint? It's like you just get the blank face. And so I think it's critical that we have individuals like you helping put the message out there that, hey, you can come to an advisor that's well trusted and not just trying to sell you something that can help you plan for this. And I know one of the things that you talked about in the past is the 5 essentials for smart investing. Do you mind breaking down what those are for the listeners?
Yeah, sure. The first one is mastering your emotions. So people are very emotional about their money. It's kind of like a religion or politics. It's people are very sensitive. People have very different philosophies of how they want their money handled. So one of the things that happens when people invest, especially if you're not experienced enough, and in fact, even professional mutual fund managers experience this. They are swayed by how the market moves. When the market goes up, people get excited. When the market goes down, people panic. And when I was working for the Capital Group, there were 3 of us, and all 3 of us are very experienced, very intelligent people. And intelligence has nothing to do with mastering your emotions. So before the financial crisis, we said that when the market drops, because we could already see the writing on the wall, people were buying real estate like crazy, no money down, no underwriting by the banks. We could see the crash going to happen pretty soon. And we promised ourselves, the 3 of us, that we will pounce and buy stuff on the cheap when the market panics. And out of the 3 of us, and we regularly talk about this almost every day. And only 2 of us out of the 3 of us actually did that. So you can tell that even some people who know what they're supposed to do can't do it when the time comes. And what I would tell people is that think of the market as an emotional person. And I'm sure, Nee, maybe you can think of someone who's an emotional person in your life. I'm betting, right?
Absolutely.
Okay. So sometimes there are days when they're happy, super happy. Sometimes there are days where they're super sad, super excited, super fearful. And that's how the market works as well. The market works as a collection of people, and these collection of people can be super excited and super scared. And so what I would advise people is that always be mindful of what Warren Buffett says. Be fearful when the market is greedy, and greedy when the market is fearful. So that's the first thing I think smart investors do. They're able to go against the crowd. The second
Absolutely.
thing was what we talked about earlier. It's just doing the research. Just don't buy stuff because somebody else said it without proper research. The third thing is being able to think long term. So most people don't know these statistics that I'm about to tell you. Before 2008, and I say before 2008 because 2009 onwards, there's a lot of manipulation in the markets with a lot of stimulus and all that kind of stuff, which we can talk about later if you'd like. But before 2008, for the last 100 plus years, if you had a 1 year investment horizon, the chances of you making money would be 56%. If you had a 3 year horizon, it'd be 2/3. If you had a 5 year horizon, it'd be 75%. And a 10 year horizon is 90%. And finally, 20 year horizon, you would make money no matter what, even if you invested at the top of any kind of bubble. So the longer your time horizon, the greater your odds of making money. So people who day trade, the odds are against them because it's just a 50-50 coin flip. It could go up, it could go down. Nobody really knows. And then the fourth thing is to be mindful of risks and not just the reward. So most people, before they invest, the only thing they care about is how much money can I make. But as a business owner like yourself, many successful entrepreneurs, they're all about risk mitigation. So the best investors in the world first ask, how can I lose money on this investment? So we try to make sure that our downside is going to be very minimal if it happens at all, and the probability of happening is very small. So that's what we want to make sure, because if, for example, you had $100,000 today, you just invested it along with whatever's going up right now. It goes to 160,000 and the stock market drops 60% after 5 years. You're going to have approximately less than 700,000. And so that's a big deal. So if you had done nothing, you would be better off, in other words. So it's extremely important to be mindful of the risk, because easy come, easy go. And then the last thing is that people need to continuously educate themselves. What works at a certain time period may not work in a future time period, because the market change, the economy changes as well, companies change, a new product gets launched, CEO gets replaced, CEO retires. So there are many things that can happen, and people should always continuously keep up with the market and educate themselves.
100% agree. And I definitely want to dive into a couple pieces here because you got me excited. The first piece is when you talk about that time horizon. That's, even when it comes to real estate investing, the biggest thing. A lot of people say that they're long-term investors, but then they get into an investment and they all of a sudden start to show short-term investment behavior, like seeing, hey, it's going down, let me get out before I lose everything. But like you said, the longer the time horizon, the more of a percentage chance that's going to go up and to the right. And so I love what you said, 20-year investment, long-term investment hat. That makes a heck of a lot of sense. And then when you talk about the risk piece, I read a book recently called The Dondo Investor. Have you
Oh,
read the
yes.
book?
Yes, I've read that book. It's been a while. I'm a big fan of Monish Pabrai, who is the author. He had a recent interview, and that interview was actually really phenomenal. So I highly encourage people to watch that recent podcast interview. I forgot which podcast it was, but it was really
I think
good.
it was Diary of a CEO. He was on Diary of a
Yes,
CEO.
yes.
I listened to that interview and then I went and got his book. And it's similar to what you said. He has a phrase in there where he says he likes to invest where heads, where when he flips a coin, heads he wins, or tails you don't lose much, or you don't, lose much at all. And it's very mitigated risk. And so that's kind of stuck in my head now. And it makes a lot of sense for your number four, right? Like be mindful of the risk. Hey, if that stock has gone up X amount, maybe it's time to rebalance your portfolio and take a little bit off the table or move it to something a little less. And then when you talk about one other piece, right? Like your track record, and we've glossed over it, but you've had many years of beating the S&P 500 as far as return volume, and that's hard to do. Like they say,
Yeah.
majority of the hedge fund managers and things of that nature are not going to consistently beat the S&P 500, so it's better to just put it in an index fund. But the fact that you've been doing that is incredible. And so I'm going to ask you to take out your crystal ball, right? Nobody's going to hold you to this, but when you look at where we are right now in the market, a lot of people would say that the pandemic and all the stimulus spending has driven us to a high, and that the tariffs and other things are keeping us at a high, and we should have crashed a while ago. But when you're looking at all the fundamentals underneath some of the businesses in the market and the AI excitement and all this other stuff, where do you feel we are in the market cycle? What do you think is going to happen in the next, we'll say, 3 years under the current presidency in the US?
Yeah. So one another person you should track is another great investor called Howard Marks.
Howard
So
Marks.
he's fantastic. So one of the things that he says is that we can't predict the future, but we certainly can understand where we are today. So where we are today, from 2009 to 2000 to till today, we've had three major things on why the market has gone up in a much smoother fashion compared to history. And the first thing is that interest rates were super low from 2009 to 2021. The second thing is that there was a lot of fiscal stimulus from checks being directly issued to people, especially during COVID, and then how much the government spends. So the government has been overspending like crazy. So last year, and again, no matter if it's Republican or Democrat, they've been spending like crazy. So last year, the government spent about 6.5% more than what they made as a percentage of GDP. And that is a lot. The only times we have seen this was during the depths of the financial crisis and the depths of COVID. We've never seen this kind of spending before. So in other words, we're spending as if we are in a recession to prevent a recession. And then the final thing is that if we look at the money supply, in terms of the Federal Reserve, of how much they print money, the money supply is significantly above trend line. And so because of all these three factors, we are at a 16-year bull market with stock prices extremely high. And you asked me for my crystal ball. So looking forward, I would say that if we look at how expensive things are, it's just a matter of time before the bubble bursts. I just don't know when, and nobody would know that. Howard Marks actually said that he feels it's like 1998. So if it's true that it's 1998, we could have 2 more years. And in fact, I do think that because Trump is a pro-business president, I think that we probably have 3 more years until, we don't know what's going to happen on the next election, but probably 3 more years before we see the bubble burst. I mean, that's very possible. But as I mentioned earlier, if your audience, and I'm just going to make a round number, as I mentioned earlier, is that if they have 100,000, for every 100,000 they have, or 10,000 or 1,000, for every 100,000, if it goes to 160,000 and then it drops 60%, you're going to have like 640,000. So you're better off sticking, I'm not saying all of your money, some of your money in cash, in a money market account, in a high yield savings account, earning 4%, so that when the market panics, then you have money to buy stocks on the cheap. And I always tell this to people, the big money is not made when everybody's excited and the stocks are going up. The big money is made when everyone's panicking and you can buy things at a big discount.
You're 100% on. And even though we have this conversation, it's almost like when you and those two other individuals were talking about the '08 crash and like, hey, we're going to buy everything. And then only two of you executed. That human emotion's a real thing. Like, this is why you
Yeah.
need help outside of yourself to make it happen. I can tell you from personal experience, Bitcoin was a thing where definitely not putting all my stuff in there, but maybe like 2%, 3%, something like that. And so I bought. when it was crashing, or it was around like, I don't know, 30,000 at some point a couple years ago. And then, or no, 60,000. And when it crashed down to 30,000, I was like, I'm getting this stuff out of here. I sold it. And now you look at it, and it's like over 100. I'm like, yeah, Bitcoin's not for me because I don't understand it. But had I just held on, now it's worth double. And so it's one of those things where if you can have somebody outside of you, i.e., somebody like Earl from Wealth Arc, to be able to advise and help you keep a steady hand when times are shaky. This is the whole benefit of going to financial advisors to kind of get that help. But what are your thoughts on two things? One, you mentioned that 20-year horizon, right? And so my mind immediately goes to, even if it does crash that 60%, as long as you have a long enough horizon, right? And you are a long-term investor and you're putting it to the side and almost forgetting about it, in the long run, you should be okay. No.
Yeah, that is okay. I would say that you, in terms of okay, you might make some money, but that may not be the most optimal approach. So most people don't understand that sometimes a group of stocks like the S&P 500 or some other group of stocks can be stagnant for a decade and not do anything. So if you invested in 1999, for example, approximately you would not have made money for 10 years. And that's a very long time for you to not make money. Yes, you're okay, and you didn't lose money, but your purchasing power, was somewhat eroded during those 10 years. If you invested in the best and brightest of 1972, they call them the Nifty 50. They're the Procter and Gamble's, ExxonMobil, Coca-Cola at that time. You would not have made money for 17 years approximately. And that's a very long time. That's if you don't care about the price. Yeah, you won't, you will eventually make money, but that's a long time for you to not make money. So inflation is eating out at you. So my advice is to make sure that when you see people getting super excited, then you should be careful in not being aggressive. Keep some money on the side, so when the market eventually corrects, then you can buy stuff on the cheap. The one thing I wanted to also maybe just mention is one thing that you said with Bitcoin. It was something that you yourself were not so knowledgeable about. That's one of the, I should have added that to the 5 smart things and make it 6, because I didn't have that on my list. And I'm gonna do that going forward, is that you need to be you need to understand. It's kind of, I guess, related to number 2, which is doing a lot more research than your vacation. So you really need to invest only in things that you really understand well. Because if you don't understand it well, then the odds are against you. So investing in the stock market is like playing poker. Do you play poker?
Not for money, but yes, I know how to play
Okay.
poker.
Okay. Well, maybe we should play for
Yeah,
money.
there you go.
But anyway, yeah, if you're playing poker, somebody wins, somebody loses. Whoever is the beginner, whoever doesn't understand the mathematics, the probabilities, they are at a big disadvantage. And that's the same thing with investing, whether it's Bitcoin, real estate, like you said, or stocks. If you are informationally disadvantaged, the odds are against you, and you are not going to make money. Or if you do, it's not, you're wasting a lot of money on the table.
Agree.
Yeah.
100% agree. And what you just mentioned is spot on. Like, you need to become an expert at this and enlist the help of experts to help you. I know personally, I'm a real estate guy. I've been doing it for a decade, and I'm hyper focused there. So I'm in the know on a lot of things, especially neighborhoods and just different products and what it costs to get stuff done. And so it does help, and it helps mitigate that risk because you're looking at it daily and you're focused on it. And the same goes when you talk about investing in stocks and bonds and all the other types of investments. One of the things that you emphasize is investing and advising your clients to invest in things that you yourself also invest in, which is huge. That's like a stamp of approval, like, hey, I'm putting my money here. Why is that so important?
Yeah. So earlier I mentioned that when I first came to the US, I was so surprised that the average financial advisor is just a salesperson. And when you have a financial advisor like that, they only care about making the commission. And some products, like insurance products or annuities, they pay a very large commission. And it's extremely suboptimal for the average person to buy life insurance products that has an investing type of component to it. There are some life insurance products that are good, but we can talk about that later if you want to. But you want to have an advisor who is in the same boat as you. So for my practice, what I do is I have 100% of my net worth invested the same way as my clients. And what that does is that it incentivizes me on my free time to always be doing research as much as possible. I'm not trying to make 100 phone calls a day and hopefully, I'll get five clients next month, something like that, and do the funnel thing. That's not what I'm trying to do. I am researching every day. In fact, before we just got on, I was just updating 30 plus stocks on my watch list, just updating my valuations of them and trying to see which one could be a potential investment. So you want someone who is in the same boat as you, because if I make money, my clients make money. If I lose money, my clients lose money as well. And if hypothetically, knock on wood, and I don't think it's going to happen, but if God forbid that I do poorly, then I have to close shop, then I have to find a job. And that's the last thing I want to do. So my clients understand and they know that as much as possible, I'm doing as much investment research as I can, because that's how we all make money.
I love this. I love this, and it's something that my team and I stand behind as well. And we're investor friendly, right? I'm an investor in real estate and other things. And so when we're helping some of our clients, because we're realtors, helping some of our clients go and buy houses, it's with that lens. Like, hey, would I buy this property? Have I bought a property right next to it, right? And things of that nature.
Yeah.
And then also when you talk about working with like CPAs and all of the above, I'm always looking to work with investor friendly ones that own real estate personally, because I know if there's laws changing, they're going to be learning that for themselves and now they can carry it over to their clients. And so I think this is huge. Like what you just mentioned is huge. I don't want that to go over anybody's head. This is someone who's actually advising you to invest in the same way that they are investing. So they're putting their money where their mouth is. And so that you can take to the bank and trust, because when they're hurting, you're going to hurt. And so when you look at how people can get started with you, and normally I don't ask this question now, normally it's toward the end, but I think it's important to get people that contact now. What type of clients do you work with? Is there like a minimum number you have to be able to invest and work with you? How do you start out with people?
So my primary service is investing in individual stocks. That is my expertise. And for that service, there's a lot to it. There's unlimited meetings. I write a lot of reports, which they get, and that's where we own the same investment. So the minimum for that is 500,000. For people who don't have 500,000, I can help them invest with funds, and I tell them which funds they can invest in with a lot less hand holding. And also some other people, they hire me by the hour and just do a review for them, give them advice that way. So there are many ways that I can help people, but the primary way is definitely for people that have 500,000 or more.
Come on now. I love it. And this is the type of handhold and on-site experience that's going to help you take it to the next level and at least maintain and continue to grow your wealth, especially as we're moving into some of these volatile times. And so I'm going to ask you just for one, if you had to pick one stock that you're watching, right? Or one company that you're watching as we head into Q4 and maybe early 2026 that you're excited about, what would that be?
Yeah. So before I answer your question, I don't want to get myself in trouble. So I'm going
True.
to read
Please.
a disclaimer. So the information provided is for educational purposes only and should not be considered personal financial advice. The views expressed are my own and do not constitute financial, legal, or tax advice. All investing involves risk. Past performance is not indicative of the future. And please consult a qualified advisor before acting on anything I'm about to share. So my best idea right now is a company called Elevance Health, and that's a health insurance company. Health insurance companies have been hammered this year, whether it's United Health Group, Centene, or Cigna, other. Basically, it's 40 to 60% down. And United Health Group has a lot of problems with it on the legal front. They're being investigated by the DOJ for various different things. But Elevance Health throughout history has been no company is like a saint, but uh, there are less legal cases against Elevance Health. So I would assume that they would have less fines on them compared to United Health Group if a fine does happen. Um, and the reason they're struggling this year, the whole group, is that aside from all the optics and the hate for health insurance companies, and I hate them too, by the way, because every November 1st, I see my health insurance bill goes up. How about you, Nee? Is that happening
Yes,
for you
every
too?
time,
It's
every time.
crazy, right? Like it's insane. And they're able to reprice every year. But why they're down this year is that some of their costs on Medicare and Medicaid have been more than what they expected. But they're able to, again, reprice every year. So next year, be able to charge more from the government, from corporations, from individuals. And that's unfortunate for us, the ones who are paying the premiums. But no matter who is in office, whether it's Trump, Republican, or Democrat, throughout the years, nobody has been able to displace them. Nobody has been able to curtail health insurance costs going down. And so my theory is that if it has not happened for decades, they're very entrenched. Their tentacles are so deep into the system that it's going to be extremely hard to change. Like it's going to be hard to imagine that the US becomes a universal healthcare system. So if next year they'll be able to reprice all their policies to be adequately covering all the higher expenses, then people will be surprised as to how much of an increase in profits they could have next year. One thing I would caution is that when I make investments is that it is on a multi-year horizon. So going back to the thinking long term, I don't invest in a company or a sector or stocks thinking that, oh, what is the price going to be next year? I look at it from a 5-year plus horizon. And I do think that over the next 5 years, Elevance Health, I think, could be something that could return north of 10% easily.
Come on now. And that is just a teaser for the folks that are listening. You can see how Earl just eloquently went through the whole analysis on that. And I love that stuff, right? I think this is cool. And to your point, even when I'm investing in stocks, Bitcoin's a whole other thing. We'll figure that out later. But I'm investing in stocks, I'm typically trying to pick something that I'll hold for a minimum of 3 years, right? A minimum of 3 years. If you don't feel comfortable holding it for that long, I think you should probably not do that.
Yeah, absolutely.
But you say that financial independence is not about chasing returns. What is it truly about in your eyes?
Yeah. So financial independence is being able to sleep at night. While you're retired or before you're about to retire, that allows you the freedom, the headspace to do whatever you want. Because if you think that, oh, I'm worried about my portfolio going down, then that kind of cripples you from doing anything. So being able to sleep at night with your investments is the most important thing. And how do you do that? And the best way to do that is having what I call a margin of safety. And a margin of safety is a fancy way of saying a buffer. So I'm going to use real estate because that's your realm as an example. So for example, we found in California, it's crazy, like how much properties cost over here. But let's just say we found a beaten up place in Los Angeles for $1 million, and you think it's gonna be worth 1.5 million in a few years because of you fixing it up, the neighborhood gets better, some shopping malls are gonna sprout out, things like that. So your purchase price is gonna be $1 million, but you think it's worth 1.5. Now, what if, and I'm not a realtor, so you tell me, but let's just say unexpected things happen. There are termites. You need to redo the whole AC. You need to do the roofing, the infrastructure, all that kind of stuff. And let's just say, again, you are the expert more than I am, but I'm just gonna throw a round number to you. I'm just gonna say it's gonna cost 150 grand total for all of those. So your cost from 1 million is now to 1.15 million. Let's say you were incorrect and you were over optimistic about the market, and instead of selling it at, you think you can sell it for 1.5, it'd be 10% less. So the 1.5 is actually just 1.35. So now your profit has shrunk from, instead of 500,000, is just shrunk to 200,000. But because you had a buffer, you didn't lose money. So what I encourage people to do to try to get that financial independence is, before you invest, make sure that you have a margin of safety, a buffer, so that if bad things happen and you don't expect it, you're still going to make money, or at least break even at, most of the time. It's kind of like when I help clients do retirement projections, and I think, a lot of people try to Google retirement calculator or something like that. Don't assume, because the market has been up 20 something percent over the last 2 years per year. Don't put in 20% as your return expectations for the next 30 years. And in fact, I have a gripe with a lot of financial planners where they use 10%, or some insurance agents, they use 10% and try to project that for the, for the far future. If the average stock market return is 10%, and you're trying to contemplate becoming financial independent at age 65 or something, you want to be more conservative. Create a buffer. Assume only like 8% or 6%. Create multiple scenarios. If inflation has been running 3 to 4%, run it at 4 to 5%. If you think you're gonna live until you're 80, but there are a lot of medical advances that could happen, project it as if you could live until you're 90, just to have a lot of different buffers, so that to make sure you can sleep well at night, and when you're retired, you can truly feel like you're financially independent.
Absolutely. I think that's sound advice. And it's one of those things where building in that buffer can make it to where if you don't need that buffer, now it's a huge win. Now you've got a home run, you're super excited. But if you do end up needing that buffer, you're not going to be mad that you had it, right? Running too tight on a real estate deal, or on even putting all of your money into one thing to where, like, hey, this is going to control your financial future, can really hurt if it doesn't go your way. And also, it can help you not sleep at night if you're thinking about that constantly. At the end of the day, you're right. You should be able to sleep soundly knowing that you've protected your present as well as your future, and that you're continuing to have your money work for you, which is the key to growing wealth and maintaining it. And so, Earl, as we start to wrap up, what are some things that you're excited about as we head into next year about your business, and what are some cool projects that you're working on?
Yeah, so first, I'm just thankful for all my clients. Without my clients, I wouldn't be here. They understand exactly how I invest, and they're extremely supportive in whatever I've done so far. So I'm extremely grateful. In terms of next year, what I actually want to do is to devote even more time to more investment research. It's doubling down on what's made myself and my clients money. I want to make even more money than what I've ever had before. And the way to do that is just to do more investment research.
Come on now. I love it. And now with tools such as, the chat GPTs of the world and things of that nature, it's only getting better. It's only going to make it uh, a little bit easier to dig deep into some of these different companies and the numbers. So excited about that. How can people reach out and get in contact with you if they want to enlist your services?
Yes, thank you for that, Nii. So we created a dedicated web page for your listeners. It's mywealtharch.com/FFM. And so let me just spell My Wealth Arch. So that's MyWealtharch. So mywealtharch.com is our main website. For your listeners, mywealtharch.com/FFM.
Done and done. And for all the listeners out there, you should absolutely go check that out. We're going to put it into the show notes. We'll blast it out with the episode when we send it. And Earl, we cannot thank you enough for joining us this evening to connect with our audience. We truly appreciate you, and we can't wait to see what you continue to do in the future and how you continue to help both our audience and many others get to financial freedom.
Well, thank you so much, Nii. It's been a pleasure. I'm glad to find, like kind of like a kindred soul in the real estate space. We're kind of like mirror image of each other and how we approach our clients. We always think about their best interests first. So I really appreciate connecting with you, and I look forward to more conversations in the future.
Absolutely. For the Ekabo Home listeners, we appreciate you for tuning in. Go ahead and hit that like and subscribe button and leave a comment to let us know what you thought about this episode. We look forward to bringing on more guests like Earl, and we can't wait to see you in the future as well.
Join us every Wednesday at 7 p.m. Eastern as we explore different types of investments that can fast track your path to financial independence.